Hello, this is Scott, and this week we're going to cover mutual funds, which if you've already done stocks and bonds, you understand a vast majority of mutual funds as well. So we'll talk about what a mutual fund is and how to classify them, how to evaluate them, and how they're bought and sold. In the most general sense, the way a mutual fund works is, let's pretend I go out and I buy $1 million worth of stocks and bonds, and I buy some stocks of United Healthcare and Target and 3M and Best Buy and some government bonds and all sorts of a portfolio of $1 million. You come to me and say, you know what? I have $1,000 and I really can't diversify on my $1,000. But what I'd like to do is I'd like to buy 1% of what you bought. $1,000 is 1% of $1 million. You would then own 1% of everything that I own of that share. So it's a way to pool money and diversify and get that leverage when often you couldn't do it. Another way to think about it is, if you came to me with $1,000, there are some stocks that are actually more than $1,000 and you wouldn't even be able to buy in. So this is a way for people to pool money and buy stocks and bonds that they wouldn't be able to have access to given the amount of resources that they have. So this mutual fund, person who goes out and decides, well, how am I going to spend that money? How should I allocate those resources? Is called the fund manager. And there are going to be lots of different funds. And these funds are going to be able to be divided into different types of categories and different risk groups. So for example, if you're a young investor, well, you want to have growth. If you're an older investor, you want security and you're willing to sacrifice some of that potential growth to ensure that you're not going to have a big loss. And maybe you want dividends. So these fund managers are going to be the ones who decide what is going to be in that investment pool and what is outside of that investment pool. Why might you want to purchase a mutual fund? For one thing, you have a fund manager there who is looking at and can classify and say, you know what, this fund is targeted for people who are going to retire in the year 2040. And they're going to manage that risk. So that way, when you get closer and closer to your retirement age, you're going to be having less stocks and more bonds. You're going to move from risky assets to less risky assets. And that's all going to be done professionally. So you don't have to try and evaluate that risk. Now, of course, by doing that, you're having to pay for that fund manager. And they're not cheap. The other reason why you may be interested is for what we talked about a minute ago, that diversification. Being able to buy across many different stocks lowers your risk of if one of them tanks. Although diversification, while it's good for minimizing risk, it also minimizes the upside as well. So this is just a brief list of some of the advantages and disadvantages. Diversification, you get a professional manager, it's super easy to buy in and out. You could buy partial shares, you could buy $100 worth of something. Even if the shares are more than that, you can switch easily within the same family. So for example, as a government employee, we use a lot of Fidelity, and Fidelity has different family groups. So I could switch from Fidelity Growth to Family Expected Retirement 2040 or 2045. I could switch all those things. Of course, the disadvantages are there are costs. And we're going to talk about some of these management fees and 12b-1 fees, which is a completely unintuitive name, but there are costs to having someone manage and do work for you. Okay, so let's talk about different types of funds, and let's start with this one. So the example I use is I went out and I bought $1 million worth of funds, and then you said, you know what, I want to buy $1,000 worth of this portfolio from you, and that was 1%. Well, what happens if instead of 100 people or 1,000 people wanting to buy $1,000, I get 2,000 people wanting to buy $1,000? Well, one thing I could do is I could just double my investment and manage a bigger and bigger pool of investments. And as a mutual fund manager, that's attractive to me because I may charge you a slight fraction. I make some money based on those sales. So if that's the case, the ability to just continuously buy new products and expand the pool that I'm managing is called an open-ended mutual fund. A closed-ended mutual fund is I bought $1 million worth of products. I'm going to chop it up into thousands, and everyone could buy a share of that. And if more people want to buy in, they can't. They would have to buy someone else out. It's closed-ended. So why would they do that? Well, it could be for various reasons. The mutual fund manager just doesn't want to expand more or make it more selective. The other one that we're going to talk about is what's called an ETF, Exchange Traded Fund, which is an index fund, which is a super important fund that we'll be talking about in the next couple slides. It's actually probably the most important mutual fund there is. So closed-ended funds, there's a fixed number of shares based on when it was developed, and they're not issuing anymore. The price of those are simply set by supply and demand. Exchange-traded funds are the most important. So an exchange-traded fund allows you to buy and sell it's not actively managed. And we would just say, you know what? I'm going to set up an exchange-traded fund that mirrors what's happening in, say, the Dow Jones. Well, the Dow Jones is an index of 30 firms. So if I just bought all 30 of those firms and I keep buying in that proportion, then my stocks and my mutual fund will always increase at the exact same proportion as the Dow Jones. Because of that, there's no management. So I'm not deciding what am I going to buy or what am I not going to buy. I just told you, we are always going to buy in proportion of the Dow Jones. Every time I need more stocks, I'm going to buy one more of every single stock. And I'm going to keep that proportion constant. You don't need an exotic manager to manage risk if you are always doing a defined rule. Open-ended funds are what we talked about before. I'm going to buy some. If more people want to give me money, then I'm going to just expand my pool. But the difference with open-ended fund is it's not an index. So I can decide, okay, I have more people who want to buy into my fund. Well, I think maybe I'll buy something in the energy market or transportation. I get to choose as the fund manager where I think I should invest. It's not defined. You are paying for my creative and insight as to where we think we're going to make the most money. So with these open-ended funds, you may wonder, well, how much do they sell for, right? You can keep buying and selling. You're buying a bunch of these stocks, and these stocks and bonds or any investment go up and down in value. So what they're going to do is they're going to look at the value of this portfolio at the end of each day divided by the number of shares that are out there, and that's going to give you the net asset value. It's just kind of like book value divided by how many people you're dividing it up by. So if you're going to buy mutual funds, you have to pay somehow, most of the time, for that management. If you're buying or paying extra when you buy into the mutual fund, it's called an A fund. An A fund is front-ended. So often you have to pay between 3 and 5% to get into the mutual fund. But sometimes it's as high as 8.5%. So you really want to watch where you are purchasing because 3 to 5% is a lot. Remember, the stock market on average since the mid-1920s has had a 9% return. The bond market has had about a 6% return. You're going to buy a mix of those two, so maybe you'll get a 7% return. If you are going to pay an 8.5% commission, you're basically giving over 1 year's worth of benefits of being invested to that purchase. So that's pretty substantial. So the opposite of front-loaded is back-loaded. These are called B funds. So instead of paying when you get in, you're allowed to get in, but then when it's time for you to leave, you have to pay a certain percentage of your money back to the mutual fund for the work that they did in managing your funds. So these typically tend to be 1 to 5%. So you have to think about this for a second. Would you rather pay in the front before theoretically your money has expanded, or would you rather pay in at the end on a higher base? Which one's better? It depends. Then there's stuff called no-load funds, and these are typically for ETFs. ETFs, you're buying in, there's no manager. They're just saying we are going to mirror some index out there. They're going to find the index and let it run. Well, because of that, there's going to be no salespeople. There's going to be no fund manager. So what they call them is no loads. You're not going to be paying a cost, although that's not 100% true. Now, you're allowed to have, I think it's 1/2 of 1% fee on no-load mutual funds, and that's to help cover the websites and the technology in order to buy and purchase the exchange. So even though it's no loads, it's really extremely small loads, and it's substantially smaller than the front end A or the back end B. So think about management fees and other charges. So management fees is the cost for managing your fund year after year after year. Now they're going to take away some of that profit and that gain that you're going to have. This is one reason why ETFs are doing so much better than other mutual funds. If you're paying me a year or 1% to manage your mutual fund compared to just investing in an ETF index, and you're guaranteed to get that or not have that 1% cost, that adds up. That's a substantial difference, especially if we're talking about the average returns in the bond market is about 6%. 1% of those 6% that's 18% of that 6%. That's pretty substantial. The 12b-1 fees is also known as a distribution fee, and that's really just to help for advertising and marketing. So think about it. If I set up Sanddock Industries and I'm going to set up a index fund and say, you know what, we're not going to have a manager, we're not going to do any of this other stuff, we're just going to set it up and it's going to mirror this sector of healthcare. And I'm going to buy in proportion of the 5 largest firms in healthcare and whatever that is. Well, I still need to let people know that that option to buy my mutual fund exists. That 12b-1 fee is limited to 1%, but if it's really low, if it's less than 1/4 of 1%, that's where it can be called the no load fee. I think in the earlier slide, I think I said no more than 0.5%, but I looked it up, it's less than 1/4%. Expense ratio talks about all these fees collectively because there's mutual funds and 12b-1 fees and sometimes other fees. So the expense ratio is really telling you how much of your profit is getting taken away from you because you want the lowest overall expense ratio. I personally don't care how it's divided up. I just want the lowest overall ratio. Our book had a nice summary of all the various different types of fees that are in a mutual fund and generally what you would expect the amount to be. Hopefully this will help summarize some of the various fees. So how can you kind of classify all these mutual funds by investment objectives? The first easy way to do it is, what are you primarily investing in? Are you primarily investing in stocks, bonds, or something else? And something else could be like the money market or something. So let's walk through some of these and further subcategorize so when you hear the term, you know what they're talking about. Now this should look really familiar for you because when we talked about stocks, we talked about the same thing. There's based on growth or income equity. We could talk about buying based on company size, buying big companies or small companies. We could talk about whether we're going to buy domestically or internationally or globally. We could talk about buying index funds or sectors. So economic sectors are like saying we want to buy in healthcare or we want to buy in transportation or agriculture or technology. Or you could buy socially responsible firms. So you wouldn't buy anything that dealt with tobacco or military or arms or that have a history of not being good to the environment. You could choose a stock portfolio based on some of those broad categories. And believe me, there are categories for everything out there. And just like bonds, right, there are several categories of bonds. You can think about high yield. Well, that's high returns, high dividends, high coupon. You think about intermediate corporate bonds or government bonds or long-term or municipal. You can think about world bonds. How they invest primarily in bonds can help determine and help you classify what you would generally describe that mutual fund as. Then we get to the other funds, and the other funds could be asset allocation or balance or fund of funds. You may be saying, well, what the heck is a fund of fund? Maybe this invests in some stock funds and some bond funds. So maybe it invests in agriculture and also invests in foreign government bonds. So you could take funds of other funds to further diversify. You could do life cycle funds. So those life cycle funds was what I was talking about with Fidelity. So you could buy funds that target based on when you expect to retire, and it will manage the risk cycle to appropriately allow more risk and more growth when you are young and less risk with less growth as you get closer to retiring. It can also do money market funds and other foreign funds. So you've heard me talk about family of funds several times. So Fidelity, just one I happen to be more familiar with, has a whole slew of mutual funds. Why do they have that? One thing is I could switch from one mutual fund to another, and as long as I stay under the Fidelity umbrella, they often don't charge me a fee to move from one type of investment to another. So that family of funds often becomes a added incentive to stay within one broker, one clearinghouse, and keep my mutual funds and my investments together. Again, we talked about this before. Managed funds has an investment manager who decides what they're going to invest in. They make informed decisions based on what they think is going to happen. But of course, if they knew what was going to happen, then investment wouldn't be risky at all. So there's always risk. An index fund does not have a manager. It is one where you lock on and you buy in fixed quantities, and there's no manager. There's no decisions to be made. So as a result, you have lower management fees and lower overall costs, and typically have a better return on index funds than managed funds. Now, it won't be surprising to you that there's going to be lots of internet information out there on various mutual funds, and here's just some of them, and feel free to research them and look at them and see what they have to tell you. Just like with stocks and bonds, if you're interested in buying, each mutual fund has a prospectus. A prospectus is information intended towards a prospective buyer, not someone who already owns the shares, but someone who is interested in potentially buying. And it also gives you information about the turnover ratio. Now, there are 3 ways you can make money on mutual funds. The first and the last one are what you've already seen. So income dividends. So if your mutual fund includes some stocks or bonds that are paying money out, that's dividends. We've seen that. Capital gains or losses, if the stocks go up or down, you can make money or lose money. The other one is capital gains distribution. And what that is if you're buying mutual funds and within the mutual funds, they are distributing money and then they use that to buy more shares or to buy more product. That's capital gains distribution.